cash portion. All right, so they're going to borrow $3.7 billion. All right. It's 20% of the whole deal, right, of the whole deal. But they're, of that 20% that's cash, they're borrowing for 100% of that. Right? So what we're going to say here, you could say just equals D26, or that cash component. But what we want to do is set up our model so that we can sensitize it later. All right, so when we do some data tables later, everything will automatically calculate. So if we want to sensitize maybe one scenario where they're actually going to use some balance sheet cash, we would want to calculate that to come out of the amount they're going to borrow. So what I want to say is D26 minus whatever they choose to fund using balance sheet cash. All right, so let's say they let's say the deal terms change. Kraft decides all of a sudden, hey, we want to fund, $1 billion of that $3.7 billion with balance sheet cash, borrow the rest. We enter $1 billion here. This automatically updates. Right? That's why I'm doing it the way I'm doing it. Right, so I'll change that back to 0. And then the interest rate on our debt, 6%. And I'm going to skip the exchange ratio for now because I don't have enough information to calculate it yet. First, I need to know how many shares are being issued in total. All right, once we know that, then we can calculate the exchange ratio. How would I figure out how many shares of Kraft stock would need to be issued here? Right. If I look at the value of the stock that needs to be issued, I know how much stock I need to issue. I need to issue $14.7 billion worth of stock if I'm Kraft. I also know that Kraft is trading at $26.67 a share right now. So if I divide $26.67 into $14.7 billion, it will tell me how many shares I need to issue. In other words, equals D27 divided by B as in boy 15. And when I do the math, it tells me that Kraft is going to have to issue almost 550 million shares. 549.6 to be precise. So now how do I calculate my exchange ratio? So basically, what we're saying in exchange ratio again is how many shares of the buyer get issued for every outstanding share of the seller. And so the way we can do this, if we know that 549.6 million shares get issued, if we divide that by how many shares are being purchased, that is, how many shares of Kellogg stock are being purchased, it will tell us what the exchange ratio is. So equals B38 divided by B12, or that 381.7 million shares, which gets us back to that exchange ratio of 1.44 that we talked about in the assumptions. Does that make sense? Okay, when we hit F9 to recalc, you should also see now that on a pro forma basis, that is after the deal is done, there will be 2.0248 billion shares of Kraft stock outstanding. And the way we calculated that is we took basically how many shares of Kraft is outstanding now, before the deal, 1.475 billion. We added to that the 549.6 that they issue, and that's our pro forma share count. Okay, so at this point, we now have the denominator in our earnings per share calculation. We know how many shares are going to be outstanding after the deal. The rest of the modeling exercise is going to be geared toward calculating what is pro forma net income of the combined company. All right, so we've already solved for half of the equation. Everybody follow that? We can also look at the ownership, like I said, on a pro forma basis after the deal is done. Because this is a stock deal, the target shareholders are going to own some of the stock of the combined company afterward, right? If it were a cash deal, then Kellogg or Kraft just pays all cash. Those seller shareholders go away, and the buyer, Kraft in this case, would own 100%. Right? But because it involves stock, the seller shareholders own some of the company, and in this case, they end up owning about 27% of the company afterward. They own 549.6 million shares out of the total 2 billion, 24 million, etc. which ends up being 27%. Kraft shareholders own about 73%. Majority control. Okay, the next thing we're going to do, because we're going to need this in our model later to calculate pro forma net income, we're going to enter a number for pre-tax annual synergies. That is, what is the dollar amount of synergies Kraft expects from the deal, or we expect Kraft to derive from the deal. In this case, we're just going to assume 0. It's the base case of our model. We're going to run the deal with no synergies whatsoever, and let's see how it comes out. And then, like I said earlier, if it looks to be dilutive at first, and this deal will be a little bit dilutive, then we'll be able to calculate, well, what if this number was higher? What if they were able to get synergies? How much would that need to be in order to make the deal break even? All right, so we're going to run this first of all at 0. Let's assume a pro forma tax rate or an effective tax rate. And I think it's 40%. Let's assume 40%. Then if you hit F9 to recalc, okay, right now you'll see some numbers in here. All right, don't pay attention to these just yet. They don't mean much until the model's done. All right, these numbers will change. But let's calculate what post-tax synergies would be. What would the formula for that be? Yeah, it's just pre-tax synergies times parentheses 1 minus T, or 1 minus B47. Again, net income is after tax. So everything we do, all of those items that can be accretive or dilutive, we need to tax affect them. All right, so if we have, say, $100 million in synergies, on a post-tax basis, that would end up being $60 million of benefit. Right? 1 minus the tax rate times 100 is 60. Okay, so we're going to run this at 0. So it's 0 pre-tax, 0 post-tax. All right, let's go down to the multiples section. And we saw it before. Kraft, we'd already populated this cell based on the spread that we had done for them earlier, based on the current share price. Gives us a market value of equity for Kraft, a little over $39 billion. Total enterprise value, just north of $59 billion. For Kellogg, we calculated 2 ways. We calculated based on their current share price. We also calculated based on the offer, right? Because we need to know what the value of the transaction is. This is what, again, we linked to earlier. Based on their current share price, enterprise value of $21 billion. Based on the offer, $23.2 billion. That number that we saw earlier. All right, so for the seller, we calculated both ways. Okay, and we can see also we've got some multiples here, both for the buyer and the seller. We've got our enterprise value to revenue, enterprise value to EBITDA multiples. We don't have anything for price earnings yet because we haven't gotten to earnings in our model. And when our model's done, we'll have PE ratios as well. All right, the interesting thing to point out here is that Kellogg actually trades at higher multiples than does Kraft. Their TEV multiples are higher. On a revenue basis, when you look at total enterprise value to EBITDA, the value of the offer ends up being higher in terms of their multiples than Kraft as well. All right, and that'll also be true of net income. So if you remember back to the slides, I talked about a buyer paying a higher multiple of earnings for a seller. We're going to see that in a moment. Right? And that's one factor here that's going to cause the deal to be a little bit dilutive. Okay, let's go over to this pro forma combined companies column though. Let's calculate the value of equity, the enterprise value for the combined company. Because it's interesting to see them on a standalone basis, but at the end of the day, what's important is what they look like on a combined basis after the deal's done. So after the transaction is complete, how many shares outstanding do we have? Yeah, remember, we've already calculated that. A lot of people make the mistake of saying, well, there were 1.5 billion of Kraft, there's 381.7 of Kellogg, let's add them together. Right? And in some of these rows, that's going to be appropriate. Not here, though. All right, so you need to be a little careful when you're putting together this pro forma column. It's not always as simple as just adding the buyers to the sellers. All right. Okay, so we know that we're going to have a little over 2 billion shares outstanding on a pro forma combined basis. What share price should we use to calculate the market value of equity? The acquirer, right. All of these shares are Kraft shares. All right, the existing Kraft shares are valued at $26.67. That's what they're currently trading at in the market. The new shares were issued based on an implied value of $26.67, $26.67. So our share price here is also $26.67, Kraft share price. Does that make sense? And to calculate market value of equity, we just multiply the two. 2 billion shares, $26.67 a share, gives us a combined market value of equity, $54 billion after the deal's done. All right, let's move down here. Again, the goal here is to calculate total enterprise value. Remember back to what we said in the assumptions. When Kraft buys Kellogg, they're going to also acquire Kellogg's debt. So over here, for debt, we're going to have Kraft's debt. We're going to have Kellogg's debt. But is this everything? Yeah. Kraft also borrows to fund the deal. All right, so again, it's not just a matter of adding Kraft's debt to Kellogg's debt. Remember, to fund that cash portion of the purchase price, Kraft is going to borrow. So to this number, we need to add that $3.7 billion in cell B33. We need to account for that as well. So pro forma debt for the combined company is $29.8 billion. Well, for preferred and minority interest, in these cases we actually can just add Kraft's preferred to Kellogg's preferred, Kraft's minority interest to Kellogg's minority interest. It's zero. But the transaction does not involve any of those items. All right, so we don't need to make any changes to those. We add them together, those stay zero. And for cash, if we add those together, we also need to add something else. We also need to add from up above any balance sheet cash that could get used in connection with funding the cash portion of the purchase price. In this case, it's zero, but again, when I set up my model, I want to be able to set it up to run sensitivities. So if I change my assumption around how Kraft finances the cash portion of the purchase price, let's say they're going to use $1 billion in cash, I need that to flow through to my pro forma model. So they use $1 billion in cash and it would automatically reduce that cash balance. Does that make sense? And then our enterprise value, if we just take the sum of cells G60 to G65, will give us an enterprise value $82.4 billion. When we hit F9 to recalc, we actually do see now some enterprise value multiples of the combined company. All right. So on a combined basis, assuming no revenue synergies, no cost synergies, anything like that, we see that you're going to trade at 1.5 times last year's revenues, 1.4 times next year and the year after. Also got EBITDA multiples as well. But no price earnings yet. We still haven't gotten to earnings. All right, we're still working on that. Any questions so far? It's pretty straightforward analysis. This is I think the easiest modeling exercise we do in this class. All right, so on to determining earnings. So I've scrolled up to the top of my to the top right side of my model, and like we said earlier, we've got earnings per share for both Kraft and Kellogg on a latest 12 months basis. Also forward earnings that we took from analyst reports. Right, so the first thing I want to do here is I want to calculate price earnings ratios for each company. This is interesting. This is going to tell me a little bit about the deal. Like I said before, if Kraft is paying a higher, if the deal involves a higher PE multiple for the target than it does for the buyer, then the market is currently valuing the buyer, and the buyer's issuing shares, that can be dilutive. So this can give us a clue as to whether the deal will be accretive or dilutive. Interesting to look at. So for the buyer's PE ratio, I'm just going to take Kraft's current share price. I'm going to lock on that because I'm going to want to copy this across, divided by their LTM earnings, or H11. And then I can fill that to the right, hit F9 to recalc. Make sure you lock on the share price. So B15 divided by H11 in that LTM column. Okay, we're also going to do this based on Kellogg's current share price. So we're going to divide B16, I want to lock on that, divided by H12. Can fill that to the right. And what we see here is that on an LTM basis, at least, Kellogg is trading at a slight discount to Kraft in terms of their price earnings multiples. Kellogg's trading at 13.7 times earnings, Kraft is trading at 13.8. But when we look at this using the offer price to calculate Kellogg's price earnings multiple, or B19 divided by H12, we can see that when we add that premium in, now the value of the deal, or the deal values Kellogg at 15.5 times latest 12 months earnings, 15.9 times next year, 15.2 times 2009 earnings. So this is what I was referring to earlier. The transaction values Kellogg more highly in terms of its PE ratio than Kraft is currently being valued by the marketplace. And because Kraft is issuing shares of its own stock, it has to issue proportionately more shares of its stock for every dollar of earnings of Kellogg. Another way of thinking of this is the numerator is growing a little more quickly than the denominator, if you look at that deal. That alone will make the deal a little bit dilutive. All right, so let's go down, let's look at our pro forma income statement. Again, like I talked about before, these blue numbers are they just came right from the spreads we did earlier. Kraft revenues plus Kellogg revenues gives us a combined revenue number for the pro forma company. We're not assuming any additional sales as a result of the deal, no revenue synergies. Right. EBITDA, same thing. Pro forma company just combines Kraft and Kellogg, no cost synergies assumed. And now what we need to do here is we actually need to calculate net income, because these earnings per share numbers are on a per share basis. They're not on an aggregate basis. We need to convert these into an aggregate dollar amount for each company. When we do that, we add them together. It will give us an unadjusted net income number that will then adjust for the accretive or dilutive impact of the deal. Does everyone follow that? So for Kraft, what I'm going to say is I'm going to take their earnings per share on the latest 12 months basis, going to multiply that by the number of shares outstanding. H11 times B11, I want to lock on B11 because I'm going to copy that across, and we've just converted their earnings from a per share number into an aggregate dollar number. All right, so that's Kraft. For Kellogg, we're going to do the same thing. Take their LTM earnings per share. Oops. H12 times their current shares outstanding, because again, these earnings per share figures were calculated based on that fully diluted shares outstanding